Welcome to Performance Optimization Strategy Basic. Myself, Surjit Kakkar. For more information on our products and courses, you can visit www.surjitkakkar.com. Before moving ahead, please make sure you go through this disclosure. I will keep it on the screen for some time. Performance Optimization Strategy Basic Part 5. In this lesson, we will cover position sizing and watch list. Position sizing is made up of two words: position, which means either long or short, and size, which is quantity of shares or contracts. A complete order includes four components: stop loss, entry, target, and size. In short, we call it as S, E, T, S. Any trade can be a stopped out trade. That is why determining proper position size is objective risk management. To determine the maximum position size, we first establish the maximum risk amount per day based on percentage of our account size. Now we divide the maximum risk amount per day with average number of trades per day to calculate risk amount per trade. Identify risk on trade, which is the difference between entry and stop loss. Divide the maximum risk amount per trade by risk on trade. This gives you the maximum position size. Let's understand position sizing with an example. If my account size is 1 lakh and the maximum risk I want to take per day is 1%, my maximum risk per day will be 1000 rupees. If my average number of trades per day is 4, I will divide the maximum risk amount per day, which is 1000, by the number of trades per day, 4. My risk amount per trade is 250. At this demand zone, my entry price is 100 and my stop loss is 98. This means the risk on the trade is 2 rupees. To calculate the maximum position size, now I will divide risk per trade 250 with risk on trade 2. The position size for this trade will be 125 shares. For objective risk management, we always want to keep our risk per trade constant and adjust the position size based upon risk on that trade. When the risk on the trade starts getting bigger, we reduce the position size, and when the risk on the trade starts getting smaller, we increase the position size. In all the cases, risk per trade will remain constant. Watchlist, safe and fun stocks. A trader must create a high probability watchlist of safe and fun stocks. There are many stocks ready to be traded, but not all of them are convenient for us. As a trader, we want to create a high probability watch list made up of stocks that are safe, which means have good liquidity, and fun, which means stocks that move. Penny stocks or cheap stocks in general may be priced low because there is no significant demand for them. In other words, big boys might not be interested in them. On the other hand, very expensive stocks will have low liquidity, which will increase the spread. Therefore, our watchlist price requirement will be a script which is trading between 100 to 3000 rupees. The higher the average daily volume, the greater the potential of easy fills and the smaller the spreads. This minimizes the cost of entering and exiting trades. Our liquidity requirement will be average daily volume greater than or equal to 5 lakh shares per day. Our watchlist criteria will be stock price from 100 to 3000, average daily volume criteria, average volume greater than or equal to 5 lakh shares in the last 3 months. Spreads should be small relative to the value of the script. This is Surjit Kakkar signing off. See you in the next lesson.